Oh, hello. Let me just take one more measurement. Got it. You know, as they say, measure twice, cut once. I've learned that the hard way. I don't want the table I'm building to be wobbly. But you aren't here for woodworking tips, though. Let's talk about auditing accounting estimates. Yes, I do know a little something about that, too. We use different tools in our daily lives to measure things, like this tape measure and this square, to help me get my angles just right. Maybe DIY projects aren't your thing, but I bet you've used a measuring cup when following a dinner recipe, or even a thermometer to see if you're running a fever. We are so used to having that one tool for measuring certain things, but the funny thing about accounting estimates is that there isn't a single specific tool for measuring them. Let me explain in a little more detail. Estimates can be found throughout the financial statements. A few fun facts about estimates are that they vary widely in nature, they are made when management can't observe the amounts directly, they are subject to estimation uncertainty because of limitations in data and/or knowledge, and they have subjectivity and variation in their measurements due to inherent limitations. Based on these factors, accounting estimates typically receive more attention by auditors than other amounts found within the financial statements, and for good reason. Estimates are made by management using methods, assumptions, and data, all of which are chosen by management. While management may use these tools to form their estimate, there is a significant level of judgment every step of the way. Some estimates, like depreciation of a building, can be relatively straightforward, but other estimates, like an estimate of expected credit losses, can be complex. Auditors need to understand all of the tools management uses to determine if the accounting estimates are reasonable or misstated. Because of their subjective nature and potential to be complex, accounting estimates can be very susceptible to misstatement. As part of the risk assessment process, auditors must consider the level of estimation uncertainty for each accounting estimate. The auditor's risk assessment will then guide the nature, timing, and extent of the procedures necessary to audit the accounting estimate. There are 3 prescribed approaches to be used when auditing an accounting estimate. These approaches can be used individually or in combination with one another, which is a matter of the auditor's judgment. We'll begin this course with discussing foundational concepts surrounding accounting estimates and risk assessment requirements before exploring the details of each prescribed audit approach. There are also specific considerations for the use of fair value measurements for estimates, so we will discuss those as well as other important considerations, including disclosures, evaluation, communication, and documentation. Understanding the audit requirements associated with accounting estimates will definitely prove to be a handy tool when you encounter your next accounting estimate.